Hey there, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into Next Level Charting. Thank you very much for joining us. I appreciate it. If you're watching this video on YouTube, and you like it, of course, please give us a thumbs up and consider subscribing. So today we're going to look at long-term breadth versus short-term breadth, because we do have some issues with short-term breadth, but there are clearly no issues when it comes to long-term breadth, and I'll show you what I mean. And then we'll look at the stock and sector weights for the S&P 500, and that is why breadth indicators are not what they tend to be when it comes to the S&P 500. Sure, you know, when the troops go one way, you expect the generals to ultimately follow, but let's face it, it's the large caps that drive the S&P 500, and as long as they are strong, the index itself will remain strong. And then we're going to break down the sectors and look at the sector leaders and laggards based on breadth. And just a programming note, I'm going to be on vacation the next 2 weeks, and so the next level charting will be on July 22nd. Have a great summer holiday if you're going away too. So here we have the S&P 500 in the top window there, and then the histogram here, the green bars are advances, the red bars are for declines, and then we take the difference. But first note that we have a horizontal line there at 450. So if this green bar exceeds that, it means you had more than 450 advancing stocks out of 500. That's a big update. And the line down there is at minus 450. So we didn't get below minus 450 on that big down day, a little over about 2 weeks ago. But the very next day, we had an even bigger up day. And you can see next we have net advances, which is the number of advances less the number of decliners. And I've got the line at 400. And we got above plus 400 there. And then you can see on that big decline, we didn't get below minus 400. And so to get to that 400 level, you have to have, say, 450 advances and just 50 decliners. So that's 450 minus 50. That is a net of plus 400 there, and we were above that. So that is a big update. And if you take that in percentage terms, you can plot that on the next chart there. There's 80%. And so we got the line at 80%. And so you can see we hit minus 80% on this decline, but then rebounded with a move above plus 80%. So that was a big up day. And when you get above plus 80%, that's the classic 90% up day. That means 90% or more of stocks in the S&P 500 advanced, and that's like a short-term breadth thrust. So we can also make the advanced decline line from net advances. And so we have net advances in the middle window here. And there's the advanced decline line for the S&P 500. And we can see that it just continues to hit new highs. It hit a new high there in May, hit one in June, and hit one here at the end of June. So there is no weakness here in the advanced decline line. We can also turn that into a volume line by using the volume of advancers and the volume of decliners here. So there it is, net advancing volume in the middle window, and there's the advanced decline volume line. And you can see it hit a new high in early June, fell, and it doesn't have a higher high now. So we have a very minor divergence working here, but I wouldn't read too much into that, as we're going to see with some of the other indicators. So now we have new highs and new lows. So we saw that the advanced decline line is in a clear uptrend. If we look at new highs and new lows, this indicator is also bullish, because if a stock is making a new high, it's in a strong uptrend and it's leading. If it's making a new low, it's in a strong downtrend and it's lagging. That is bearish. And as long as you have more leaders and strong uptrends than you have laggards and strong downtrends, you're okay. And you can measure that with new highs and new lows. So we've got new highs here, the green histogram. We've got new lows, the red part of the histogram there. And you can see in late February, February 27th to be precise, we had a dip below minus 50. So this line is at plus 50, and this one's at minus 50. And so when you go below minus 50, that means that more than 10% of stocks in the S&P 500 are hitting new lows. That is bearish. And that foreshadowed the COVID crash. And it took a while to stabilize here. And it wasn't until July that we got back above plus 50 there. And we've been making moves above plus 50 on a regular basis since then. We had a big surge there in May. We've had sporadic, new lows, but we haven't had anything that has threatened the overall uptrend. And you can see it's clearly green, so there are enough new highs to support the uptrend. This indicator below is high-low percent, which is the number of new highs less the number of new lows divided by the total number of issues in the S&P 500. And these lines are set at plus 10% and minus 10%, which basically mimics what we're seeing on that first chart I showed you at plus 50 and minus 50. But bottom line, we're in bull mode when it comes to new highs and lows, and that's a longer-term indicator. Another indicator is the high-low line. Now, this is based on high-low percent, which you just saw, and it's a cumulative measure of high-low percent. So as long as new highs outpace new lows, this line will rise. It's kind of like the AD line, but it's a lot smoother and more longer term. And you can see I added a 10-day exponential moving average, the pink line, to show when it's rising. And it has been rising since the latter part of April. It had a little bit of flatness there in September. It didn't turn down really. And it has stayed on a steady rise and supported this uptrend in the S&P 500. So until this line, this high-low line, breaks its 10-day EMA, I don't see any signs of weakness in the S&P 500. So here's the indicator that has everybody concerned, and that is the percentage of stocks above the 50-day SMA here. So on this chart, I've got the percentage above the 50-day SMA for the S&P 500, percentage above 150-day SMA, and percentage above 200-day SMA. Now, what's important to remember here is that the percentage above the 150-day and 200-day SMAs, that is more of a long-term trend type indicator. Percentage above the 50-day SMA, that's kind of getting into mean reversion territory. And what I mean by that is when you get a break below the 50-day and you're still in a long-term uptrend, that's usually just a pullback within that longer-term uptrend. And it's not necessarily a precursor to a bigger trend reversal. And if we look back at the percentage of stocks above the 50-day SMA, you can see it deteriorated here, but then rebounded, kind of deteriorated there, flattened, it got a couple dips below 30% there. You had some deterioration here again, but then rebounded again. And now we peaked here in May, and we've got deterioration or peaked in April, and we've got deterioration over the last few months. So the dips that we've had have been below 50% here in January and March, and then below 40% in June and October and September. But we haven't had that dip below 20%, which is the red line. And that's when you have so much downside participation that you become concerned. Now, I never use just one indicator. I always use a group of indicators, and it's usually an odd number to try and get a consensus for a signal. And you can see for percentage above the 50-day, I've got lines at 80% and 20%. For percentage above 150-day SMA, I've got lines at 70% and 30%. And percentage above 200-day, I've got lines at 60% and 40%. So if you look back here to late February, you can see that we had these signals trigger. So we had a signal when all three broke below those lower lines in late February. And then we got a bullish signal when two of the three broke, well, actually all three broke above in June. So we had a bullish signal in early June there. We had a little bit of a whipsaw because percentage above 200-day went back below 40%, but percentage above 150-day held. And this group has been bullish ever since. And until we start to see two of the three break below their bearish thresholds, which would be below 20% for percentage above 50-day moving average, and below 30% for percentage above 150-day SMA, and below 40% for a percentage above 200-day SMA, we don't have a long-term downtrend, I don't think. We're still in a long-term uptrend, and that means that this deterioration in percentage above 50-day SMA is more corrective in nature than a warning of a major trend reversal. So I am on the State Street SPDR website for the S&P 500 ETF, and I'm going to look at the holdings here. Because when it comes to breadth indicators, keep in mind that an advance is +1 and a decline is -1. A new high is +1, a new low is -1, regardless of market cap. But that's not the way the S&P 500 SPY works. When we look at the holdings, we can see that large caps dominate, especially we look at the top 5 here because Alphabet counts twice. But there's a heavy weighting there. We basically have 12, 14, 16, 18, 20% in the top 5 there. And then when we look at the sectors, of course, we can see that it is dominated by technology. So you can see that technology is 27%, healthcare 13%, consumer discretionary, financials, communication services between 11 and 12%. So technology is clearly the 800-pound gorilla in the market. So we also need to keep that in mind when we're looking at the S&P 500. What are the sectors doing as far as breadth is concerned? So first, let's look at the percentage of stocks above the 200-day EMA for each sector. And here is technology. You know, it's been hovering in this 80 to 100% area for several months, basically since November. Consumer discretionary, it's been hovering in that 80 to 100% area for several months since late November. Finance, it's been hovering in that 80 to 90 or even that 90+% area for several months. Industrial is the same. So the long-term trends within the sectors are fine as far as percentage above the 200-day. Now, communication services only has like 22 stocks, so it's a little bit more volatile. But you can see it hasn't dipped below 70%. And healthcare has had a couple dips. It hasn't dipped below 60%. And for the most part, has been very strong as well. And those 6 sectors account for like 80% of the S&P 500. And when you're looking at weighting the S&P 500 and handicapping performance, these are the 6 you need to look at. And we can also do this for the percentage of stocks above the 50-day moving average, and this will kind of tell us what's happening on a shorter term time frame. And the biggest thing that stands out is look at XLK, percentage above the 50-day moving average, rising since the middle of May. We look at consumer discretionary, it has been falling. We look at finance, it was holding strong, but then took a tumble in June. The same with industrials, holding strong, but took a tumble in June. And then we look at the other 2 big sectors, communication services, kind of weakening in April, May, June. And then we look at healthcare, a little bit of weakening, but holding flat pretty much. And any of this weakening is really a corrective move within a bigger uptrend for all of these sectors. So if you'd like to know more about trendinvestorpro.com, you can click on the link below in the description. Again, if you like this video, please give us a thumbs up and consider subscribing to StockCharts. Thanks again for tuning in. Have a great day, and I'll talk to you again next week.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.